With the median price of a single-family home in the greater San Fernando Valley now hovering around 1.15 million, more buyers, both first-time and downsizers, are turning to condominiums and townhomes for more attainable option, where median values are closer to 675,000. And on the surface, well, I have to tell you that makes sense. But before you buy into a condo or a townhome community, there are a few things you absolutely need to review because not all associations are financially healthy, and that can directly impact your equity and your ability to sell later. Today, I want to walk you through what I advise every condo buyer to examine before jumping in with both feet. This isn't about fear, it's about being informed. The first place to look is the association's budget, and specifically, take a look at the reserve account. Every HOA is required to maintain reserves to fund future capital expenditures. Think roof replacement, exterior painting, wood repair, pool resurfacing, the major infrastructure. The reserve account is essentially the community's savings account for big ticket items. And here's the issue I'm seeing more frequently. Some associations in the valley are funded at less than 10% of projected future needs. That's extremely low. And if reserves are underfunded, there are only two options: raise monthly dues or issue special assessments. And when the California insurance crisis hit, many associations were caught off guard. Insurance premiums in some communities went from hundreds of thousands to several $1 million annually. Communities with weak reserves had no cushion. The result? Think special assessments, sometimes 20, 30, and even up to $50,000 per unit. That impacts affordability, that impacts resale, and that impacts buyer financing. You see, for FHA and VA financing approval, associations have to have at least 10% reserve funding. If the association falls below that threshold, buyers using government-backed loans may not be able to purchase there. That reduces your future buyer pool, and fewer eligible buyers can mean downward pricing pressure. Here's a real-world example, one I lived through. And in the Rock Point Homeowners Association, reserves are currently funded right around 45%. Major capital improvements, think roofs, fences, exterior paint and woodwork, well, that work's already been completed. So when the insurance crisis struck and premiums jumped from roughly 500,000 to over 3 million annually, the association was strong enough to absorb much of the shock. For the first time in its 50-year history, Rock Point issued an assessment, but it totaled 2,000 spread over 2 years. Compare that to some of the communities that assess tens of thousands of dollars per unit. Very few buyers actually read the CC&Rs, and they should. Inside that document, sometimes 3 inches thick, you'll find what the HOA covers, what you're responsible for, maintenance boundaries, and architectural rules. And critically, you'll discover whether the master policy is walls in or walls out. Walls in, well, that means the association master policy covers full restoration in a catastrophic loss. Walls out, the association covers structure to the bare walls, and you have to ensure the interior finishes under an HO6 policy. That matters tremendously for proper coverage. Now, pro tip here, I strongly recommend condo owners carry special assessment coverage of at least $50,000 on their HO6 policy. It may cost a couple $100 per year, but if a major assessment hits, that rider could be the difference between financial strain and protection. The other section you should be looking at is the rules and regulations. There you're going to find parking restrictions, pet policies, rental restrictions, use of common areas, and architectural guidelines. Some buyers discover restrictions that are just untenable after closing. I gotta tell you, that's not ideal. You need to know what you're stepping into. Now, here's the thing. As affordability pressures increase, more buyers are shifting into attached housing. That makes HOA financial strength more important than ever because the difference between a well-managed association and an underfunded one can mean stable dues or escalating costs and surprise assessments. In today's market, predictability is valuable. Condos and townhomes, well, they can be a fantastic housing option, but they require an extra layer of due diligence. If you're considering buying in an HOA community, well, reviewing the financials before making an offer can protect both you and your budget and preserve your long-term equity. If you're thinking of selling, whether it's a single family home or a condo, I've created a free guide, Avoiding a Failed Sale, How to Sell Smart and Walk Away Without Regret. You can get it at my website, mrchatsworth.com/ebook. And until next time, I'll see you around the neighborhood.